What I'll talk about today is how to get a whole life insurance policy if you're getting it because of the cash value. And what I'll do is show you exactly what I would do in this case. So we're assuming that I say I'm going to get a whole life insurance policy, and the main reason why is because I am interested in the cash value. Number one, I want to have as much cash value as possible. And number two, I want to use that cash value. I want to use it for my business through the loan feature so I can use it like a line of credit. And then second, when I retire, I want to use the cash value to take income tax free. So here's exactly what I would do. We'll break it down into 2 steps. And this is what I would do to make sure that I don't have buyer's remorse and I am set up for the highest level of success. Step number 1 would have to do with the actual insurance company that I choose. What I would not do is just move forward with the insurance company that the agent I am speaking with recommends, because that's the company that they work for or the company that they prefer. The reason why is when you look at the number one source of buyer's remorse with whole life insurance sales, when someone's interested in cash value. So if I said, I want a whole life insurance policy and I want it because of the cash value, what is going to have the highest chance that I'm going to be dissatisfied with that or cancel it because I felt like I was ripped off? Here's what it always comes down to. I see an illustration. Let's pretend I buy a policy from you and you say, hey, Steve, if you keep putting money into this policy, in 20 years, look at this cash value. You're going to have $1 million. I say, that's fantastic. I really want this. And I love it because when I look at the benefits of the cash value, and this is consistent with all life insurance companies, the cash value works per the IRS standards, but what you'll see with the cash value is that it is a safe place to put money. I can access it like my own personal line of credit. And if I do everything right, it's got a nice tax benefit. I could use it tax-free. So I'm super attracted to this. 20 years, you telling me I'm going to have $1 million? You say, yes, you will, according to this illustration. But then the 20th year rolls around, and I don't have $1 million. I have $700,000. I say, what happened? That's $300,000 less than what you told me I would have in cash value. I'm not happy. And what happens here is people usually cash out earlier because the policy does not perform as illustrated. It under-delivers. To summarize, expectations are set here and they end up delivering down here. Happens all the time. Like, this is the problem with whole life insurance when someone's interested in the cash value. So where we have seen this not happen the most is with 4 companies, which are Mass Mutual, Guardian, New York Life, and then Northwestern Mutual. These 4 companies are considered to be the 4 major mutual life insurance companies in the industry. So what that means, the 4 major mutual companies, is 1, if you look at their company size, they're all massive. Number 2, if you look at their financial ratings, their safety ratings and strength ratings, they are cream of the crop. There is what is called a Comdex ranking, which is kind of like a financial grade. The highest is 100, if you're going to get 100 on a test. All of these companies range between a 98 and 100. Most of them are a 99 or a 100. But high rating, that means they're both financially stable and very, very safe when you look at the safety ratings carriers. But the biggest selling point, in my opinion, is when we look at real life insurance policies, so not illustrations, but real life insurance policies that have lived the test of time. I've seen the strongest actual cash values with these policies. To give you some data, I've seen internal rates of return consistently higher than 4%. Depending on the time period, we've seen internal rates of return between 5 and 6%. And the time period is very important. So we have all of this data. So we have policies that were started in the 1970s, the 1980s, the 1990s, 2000s, and then let's just call it 2010 onward. And when we look at whole life insurance policies with these companies that were started then, we see strong internal rates of return. When we look at them with other companies, when we're able to get that data, I haven't seen it. We've gotten some policies from other companies, but the IRR isn't 4%. Sometimes it's less than that, where it was projected to be 5 or 6%. Imagine that. You see an internal rate of return that projects 5%, of let's say $1 million long term, and then it only delivers 3.5, and you end up having $700,000. It's like, hey, not cool, man. Like, just tell me what it's supposed to do, or who has a track record here. So, number one, what I would do is always look at the insurance company, and at a minimum, I would consider one of the 4 major mutual companies. Also, the easy thing to do here is you can just follow the money. So before I got into business for myself and learned how to talk to people, I worked at an executive benefits planning firm where my role was designing policies for corporations. And what I would do is research the insurance carriers that we were looking at, look at historical performance, and then also design the actual whole life insurance products for the company that was making the purchase. And when you look at corporations and even banks, where they go first is guess where? 4 major mutual companies when it comes to cash value life insurance products. And there's a reason for that, mainly because we have the proof of performance. Not hypotheticals, it should deliver this. Yeah, it should always deliver a certain growth rate. But the reality is, a lot of times it doesn't. So when it comes to people's money and setting expectations properly, I feel that that's so important. And just to close out this point around step 1 in company selection, if I put you in a policy and you have buyer's remorse, you say, hey, this isn't what I thought, I'm really unhappy with this policy, there's only so much I can do as the agent. The actual cash value performance over time is very dependent on the insurance company. So if you're not happy with whole life insurance, who are you going to be more dissatisfied with? The insurance company or the agent? So you've got this big company, here's a skyscraper, right? There's the doors, the windows. You can tell I was an art major in school. Just kidding. Or me. Who are you going to be upset with? This guy right here. The company, it's like, yeah, you might say, hey, don't do business with that company, but from a reputational standpoint, it's going to hurt me a lot more than it's going to hurt them. And I say that because that personally is like the most important thing for me, period. Like being in business, it's not for the money. Yes, we're in business to generate revenue and such, but treating people's money and their situation how you want to be treated, that's much, much more important. So when we're setting up a life insurance policy for someone who says, I want this because of the cash value, step number 1 is company selection and making sure we pick a company that has consistent proof of performance, a track record of actually delivering. I'll talk about which specific companies I would pick after we cover step 2. So step 2 is the actual product / product design. This is so important. So getting a whole life insurance policy for cash value. What I would not do here is just buy a life insurance policy. So if you just buy a life insurance policy for $1 million, what'll happen is that'll cost you a premium, depending on your age, Could be 10 grand per year, could be 50 grand per year. Depends on the product too. So let's say it's $10,000 per year. We'll keep things super simple. You're just buying life insurance. You'll have zero cash value or very small amount early on. You'll have life insurance, but you have to consistently pay that premium to see any real value generated. So you pay that $10,000 cash value in the first year is zero. It's like, no, I wouldn't do that. No thanks. So continuing on here, what would I do? Here we go. Instead of saying I want to buy a $1 million policy, I would say, here's how much money I'd like to be able to pay into this policy. Or here's the most amount of money I want to deposit on any given year. For example, I might say $10,000, that's my high-end number. That's my ceiling. So if $10,000 is my ceiling, I would not just say, show me a $10,000 premium, because that would give me $1 million death benefit if we go back to the what not to do example. What I would do is say, I want the most cash value. So here's the cool part. I would set the premium as low as I can. What you'll see is with those top insurance companies, I can usually set the minimum premium at 10% of whatever my ceiling is. So if I said the most I am ever going to pay into this policy is 10 grand, I know the insurance company will allow me to set the premium at about 10% of that number. So that's my commitment. I'm billed for $1,000 per year. And then I have the option to add more money to the policy through what is called a paid up additions rider or PUA rider, which here I would add the other $9,000. Add the two together, it gives me 10K. If I said I want to take a very disciplined approach and save $10,000 every year for the next 30 years until I'm 65 years old, I would select that 10K per year of those major mutuals. This is just me personally. I would pick Mass Mutual because their product, certain versions of it, or certain products that they offer, accommodates long funding periods very nicely, where I can have this 10% premium. So this we refer to as a 1090 split. I can have a 1090 split, which means a $1,000 minimum premium commitment, and I can fund it for the next 30 years. And if life happens and I can't pay $10,000 for whatever reason, that's okay. I'm not on the hook to do that, which is very nice. So I don't want this to feel like a burden at all. What I would do is just reduce my funding 1 year or multiple years to $2,000 or $5,000. Can it go as low as $1,000? So I set it up to be very, very flexible. If I said I want to be able to fund $100,000 per year, and I'd like to be able to use this for my business. However, my cash flow fluctuates. I can't always put in 100 grand. I think I can hit that number, but if I have to write a check for $100,000 on a certain date every single year, it's going to stress me out a little bit. So if I felt like that, I would actually choose Guardian. Let's do it this way. And the reason why is because what you'll find, Guardian has a lot of PUA flexibility. They're one of my favorites for that exact reason. And they invest a lot into technology. All of the companies do, but I do like Guardian. So here's an example of it. I could have that same 10% minimum premium, 10% of what? Of my ceiling. So I said the most I want to be able to fund this policy with is $100,000, which means my premium commitment would be what? 10% of 100? $10,000. That is how much I get billed for every year. I could break that up over 12 monthly payments if I'd like, but that's my minimum. In the first year, that does not show up in cash value. Beginning the second year, that does show up in cash value. So the first year is the worst year. However, this PUA rider, I'll set it up to be optional because I feel like I'm dumping money into cash. And I could add 0 here. I could add 10,000, but I set it up where I can fund up to 100K per year, so I can throw another 90 grand into that paid up additions rider. I am not billed for this. I wouldn't set it up that way. You can, but this is me, how I would do it. I would set it up where I can just go on my online account, send in a check, use my mobile app, or send in a wire transfer to feed money into this paid up additions rider. I would do it at my discretion. That is what I do with my policies. That way it's a lot more flexible and I never feel like the policy is burdensome. So Guardian is very accommodating to that type of design. So of those 4 major mutuals, if you're taking a consistent funding approach, you can't go wrong with any of them. I will say I like Mass Mutual and Guardian. Personally, I do like Guardian with their flexibility, especially if you want to fund for a short period of time. So one of my policies I set up where my plan is to aggressively fund the policy for 5 years. After that, I don't have to pay anything. I can if I want, but I don't have to pay anything after that. And really, I just want to try and get the cash value to a large target amount, watch it continue to grow, but then use it as a personal line of credit for opportunities when they come around. Because why I'm interested in the cash value, going back to why get whole life insurance for the cash value, here's a big point of interest. Point number 2, access. When you access the money in a policy, it continues to compound. So let's say I've built this policy up and I've got a cash value of 500 grand. Right? So I've got $500,000 compounding for me. If it's earning 5%, if I let it sit and grow, it'll earn 5%. If I say, hey, here is an opportunity over here, I want to purchase this piece of real estate or use my policy to do so, I can borrow against it at $300,000. It's quick. I don't have to be approved for the loan or anything like that. I pay it back however and whenever I want. Usually when a loan's outstanding, what I like to do is at a minimum, I'll pay the interest annually because I'm only billed for interest one time per year. And then at my discretion, I'll throw money at the principal balance. Just as a business owner, cash flow is going to fluctuate. So I like having that flexibility. And that's what I've always done. So the loan rate is going to depend on the product I used and such. Say it's 5%. What's 5% of $300,000? $15,000. What's 5% of $500,000? 10% would be $50,000. So cut it in half. It's $25,000. So I've got that positive $10,000 spread. Now with that said, I'm going to see a positive spread like this only after I've had a policy in force for several years. In the early years, I'm negative. So down here, talking about product design, if I pay 100 grand, nothing of the premium showed up in cash value. My first year cash value, if I put 90 grand into the PUA rider, it's going to be somewhere between $85,000 and $90,000 in year one, depending on the product and a couple other things. So I'm negative in the first year. So if I borrow against that $90,000 in year one, I've got a negative return and I'm paying loan interest. So I would not have a positive spread. And I always like to mention that because you can generate positive arbitrage when leveraging a life insurance policy, but you could also not do that and have it completely messed up if I just look at the percentages. What we always like to do is just look at the dollars. This way people can see, what am I paying in interest? What am I getting from the insurance company? Just show me. This way I can make an informed decision based on the numbers. Even if I'm negative for a little bit, at least I see it and I can quickly get out of the red. That's the big thing, providing awareness, setting expectations correctly, and that usually results in people being very, very happy with their policies. But to summarize here's exactly what I would do if I'm getting a whole life insurance policy and I'm getting it because I'm interested in the cash value. I would look at one of the 4 major mutual companies. If I like flexibility, I would look at Mass Mutual and Guardian. New York Life and Northwestern Mutual do offer flexibility. They also work more closely with their career agents. I am an independent broker. Mass Mutual and Guardian work much easier with independent brokers. Northwestern, for example, we can't even use because they only work with their career agent sales force, but still a quality company. That's why we talk about them. But the flexibility features, when you look at the product limits, are most favorable, in my opinion, with Mass Mutual and Guardian. So step 1, company selection. If I like the idea of having a very flexible policy, committing to the minimum and adding more discretion, I would look at Mass or Guardian. And then with product design, I would drive the minimum premium as low as I possibly can, because that will, 1, give me as much cash value as possible right out of the gates. And then 2, it makes the policy very, very flexible because I'm only obligated to pay the premium. So if someone says, I want to fund $10,000 per year, but then a year comes and that 10K feels impossible, but they can easily do 1,000 or maybe 2,000 if they pay more than the minimum. Now all of a sudden they don't have stress over an asset that we're trying to really make work and enhance their life, so they can use it for their business, real estate, retirement, whatever they'd like, which people we work with use it for everything. So I do hope that this was helpful. Let us know if you have any questions at all. And as always, I hope this helps. Thanks so much for watching.